we saw a lot of stories about decoupling of India in 2006-07, wherein like whatever happens to the globe, India will continue to grow and its economy will do well. We are again getting into that kind of phase right now. Europe is going into deflation. China is kind of slowing down, like at 7% kind of growth rates. US is talking about increasing rates maybe in 2015. Is this kind of a decoupling theory right, and will it work for India this time, or is it again like something that we saw in 2008 when the entire market crashed when the US economy went through a turmoil?
So I'll begin with a cliche that this time is different. But having said that, if you actually see in 2006-07, what was happening was that all the countries were growing fast. And there was unanimity in the sense that everyone believed that this is going to continue. So I think what happened post that was very surprising. This time, on the contrary, you have been so cautious last 3-4 years, despite almost all the factors. I'm talking about global markets now. All the factors slowly turning positive. There's always been some hesitation, whether it was a fiscal cliff, QE tapering. Now those events come and those events gone. There is no, in fact, buying of bonds by the US Fed, and despite that, the yields are where they are and the markets are where they are. So this time the investors have been a little bit more cautious. Coming to India, I think India is actually getting into a phase where it is getting differentiated from the world. So last 4-5 years, whereas the world saw continuous inflation going down and interest rates being reduced, India, on the contrary, had high inflation rates and almost the highest ever, interest rates. What we are seeing now is, which Mahesh also touched upon, that there is a possibility that interest rates in the US and other economies will start to inch up. India, on the contrary, there is no denying the fact that interest rates are only going to go down. It might happen in December, it might happen after 6 months, it might happen after 1 year. The timing might differ from person to person, but the direction is very, very clear. So in that sense, actually this time, we are actually a differentiated kind of an economy. And we also have to remember that after 30 years, we have got a decisive mandate as far as politics is concerned. And that is important because that swing of 1-2% in GDP is definitely due to government policies, all things being equal. And I think there is a lot of hope on that front. The first 5-6 months has begun well. The expectations as we move forward in the next 3-4 months is very, very good. There is an expectation of rate cut. There have been some very good ministries being formed. There might be a rating upgrade as far as Moody's is concerned. We have a budget which is expected to be a differentiated kind of a budget. So that also will mean that India would, in the sense, be a little differentiated from the world.
Sure. I think one of the things that is spoken about is obviously global risks. So Mahesh, how do you look at what are the other risks that people should look at in terms of, let's say, local policy, or how do you see what are the kind of things you would like to see from the government in the next 1 year or 2 years so that the market can move up to the next level from where it is right now?
Yeah, as you rightly said, that global risks are something which are immediately in the horizon, and especially whether it emanates from Europe, okay, we are seeing a slowdown over there, or whether it is China. But I think local risks also one needs to be cognizant, because a lot of rally in the market which has happened in the recent past been on expectations that, okay, you will see reforms coming through, especially in sectors like coal, power, which are big issues, okay, which are hampering the growth and the investment. A lot of money is still stuck in some of these projects, and unless some of these issues are resolved, clear policy, we know issues about coal mines getting deallocated. Now I think quickly needs to come a policy in terms of how we're going to allocate these mines back, because unless that is done, you won't see the risk appetite coming back in terms of promoters committing capital for new capex and new projects. And that is really important if the new cycle has to begin. So I think some of the decisions on some of these issues in the next 3 months, 6 months is something which the market would like to see positive steps on that.
Anoop, I think one of the other debates which is going around in the industry, and probably SEBI is also talking slightly tough on it, is in terms of the close-ended funds and many launches of close-ended funds which have happened and have collected good amounts, but mainly on account of commissions which have been given out by the industry to most of the advisors. What are your thoughts in terms of in terms of managing these funds? Are they really beneficial from a fund manager standpoint rather than an investor standpoint?
To me, it's a straightforward business decision. There is no gun on anyone's head to sell or to buy those products. You get into them with your eyes open. Don't actually develop a conscience after you have been to the trip abroad and that's all the other benefits. If you want to have conscious before the trip is announced and all the race announced. Coming to us from our point of view as investors, what we are doing is that we have a very specific aim in terms of what those schemes would invest in. So, and therefore, for us, it's a very actually fairly easy job to do, except that the timing part puts a lot of luck element in terms of your return, because these are fixed period returns. So the time when you start and the time when you end will actually have a disproportionate level of impact on your overall returns, which people don't really realize. So I'll give you an example. I used to work with Kothari Pioneer earlier, and we had a closed-end scheme called Blue Chip Fund, which used to trade at a significant discount. And we all thought that the best way to invest our bonuses was to buy it from the market, because there was a discount of 4.5 rupees on an NAV of, and then the discount will. But the thing is that when the 3-year period of that scheme came, it was also the mid part of a bear market, where there was a 40% drop in NAV in just 7 months' time. So which is the element that we keep on stressing to our investors, is that there is a whole lot of element of timing in these products, which can have a big impact on your overall returns. In terms of investment strategy, we've been fairly clear in trying to showcase what we'll do. But in terms of the return expectation, I have a feeling that investors and distributors do not really appreciate that element of timing, when you've launched a product and when you want to close it, because these are all prefixed. There you don't have the flexibility to extend them. So that part people have to be a bit more careful about.
What we have spoken about so far, the long term, everybody seems optimistic about India. Coming more closer, maybe 2015, and this is a question to all of you, maybe Anoop can start and we can have a round. What does look more attractive right now from a 1-year perspective? Is it equity or debt?
We should look at investing in equities, for example, as an equivalent of what we do in terms, for PF. Most of us are employees of companies where we get a PF and it stays with us for our entire working life. I haven't met too many of my peers who look at their PF balance every 6 months to see where they are and how much it is. Same way, why do we have to look at our equity investment every year or every 6 months and either get euphoric or get down in the dumps? I think so the time is fairly well set for us to look at a really long period of time, which is more than 15 years when you do an SIP. And I think that's what really matters. We've done one study of the BSE Sensex. There's only a 44% probability to get positive returns, just on a 1-year basis. That's the track record of BSE on a 25-year period. So you can as well toss a coin and get a higher probability. So I think so first of all the time frame for equity has to change for all of us. So these questions then become irrelevant. So then I can ramble along for a long period of time, without answering that question.
Mahesh, your thoughts on this?
I think Anoop has given an answer for all of us in a way, I would say. I think when the investment horizons for equity can't be set on a 1-year basis, because I think you have to look at, it might so happen that 1 year the markets might not give any return or even negative. But we see in 1 year, market can give 50, even 100% return. We have seen in the past. So it's important to be in the market as long as the long-term outlook is fairly decent, and which it looks at this point in time. we are at a phase where, as I said earlier, beginning of a cycle, things will improve, interest rates will go down. That also, in a way, see, investing in a debt probably in a 1 year, okay, you can play the interest rate cycle, but then there is a reinvestment risk which is there. And if interest rates go down, automatically the valuation outlook for equity would also increase longer term, because the cost of equity will go down. That will probably justify a higher multiple for the market. So I think clearly the risk reward looks in favor for equity for investors, and obviously one should maintain the right asset allocation.
Prashant?
I think outlook is positive for both equities and fixed income, in my opinion. But I think there is less merit in investing in equities with a 1 year view. So I think if investment horizon is only 1 year, then one should prefer fixed income. But equities, you should come with 2, 3, 5 year views. The risk is less in equities over long periods, and it also gives it more time to compound.
Sunil?
I think from our perspective, we are playing with one major thing in mind, which is that between 2014 to 2020, earnings will triple.
Sure.
And I think that is basically what we are playing for. Now, if the market starts to discount that earlier, we might make returns in 1 year. If the market basically discounts it a little back-ended, then there's a possibility that that 1 year might not lead you anywhere. So I think I agree with everyone, and I think you would also agree that when you're looking at investing in equity, look at it from creating wealth, not from creating income.
Right.
If you want to create income, there are different avenues available for you. But if you want to create wealth, look at investing in equity. India is a great economy. We are already among the top 10 market cap companies in the world. We will be from 2 trillion, definitely be going to 4 or 5 trillion, in the next 6, 7, 8 years, depending on how bullish a person is. And that is the kind of wealth which will be created eventually. So I think have focus, be long term, and you'll make money.